Most people have no idea how fast the wealth gap widens with age. Today, you'll see the real net worth numbers of the richest 10% and what you can do right now to join them. Let's start with ages 18 to 24. In this group, the richest 10% typically have a net worth around $20,000 to $40,000. That doesn't sound like much, but here's the insight. It's almost never from investing returns. It's from early savings habits, low debt, and sometimes family help. The takeaway is simple. At this stage, good habits compound more than money does. Limit consumer debt, build a small emergency fund, and begin investing something consistently, even if it's small. Your goal at this age is behavior, not impressive numbers. Set up an automated investment into a broad market index fund and track expenses ruthlessly. The gap is tiny now, but this is where the future separation begins. Ages 25 to 29. Now the richest 10% crank up to around $80,000 to $150,000 in net worth. This jump is driven by income growth, early investments gaining momentum, and avoiding lifestyle upgrades. The key behavior here is resisting the urge to inflate spending when your salary rises. Focus on paying off high-interest debt, building a 6-month emergency fund, and maxing out tax-advantaged accounts if available. Action step: funnel 50% of every raise into investments. This is the period where you build speed. People outside the top 10% spend everything. The top 10% invest aggressively. Ages 30 to 34. A major leap, $250,000 to $400,000. This is where compounding and career positioning collide. High earners begin to dominate this segment, but discipline still matters. To climb into this bracket, negotiate salaries every 2 to 3 years, acquire skills that create leverage, and start prioritizing asset accumulation, index funds, rental property, or owning part of a business. The number one error in this age range is buying too much house. Keep housing costs below 25% of take-home income. Protect your investing momentum at all costs. Ages 35 to 44. Here the richest 10% hold around $600,000 to $1.3 million. This is where the gap becomes obvious. Compounding is now visible. Their investments have been growing for 1 to 2 decades. Actionable insight: optimize taxes and fees. Small percentages now equal tens of thousands later. Increase retirement contributions, eliminate bad debt entirely, and invest in cash-flowing assets. If you are behind, accelerate income growth, promotions, side businesses, or consulting. Your margin for error shrinks, but the ability to catch up still exists if you increase savings rate aggressively. Ages 45 to 54. The richest 10% sit around $1.5 to $3 million. Diversification becomes critical. At this level, wealthy households often own taxable brokerage investments, retirement accounts, real estate equity, and occasionally business equity. Risk management matters: insurance, estate planning, and rebalancing portfolios. Avoid speculation. Your wealth engine should be broad market exposure, not casino trades. Aim for a 40% savings rate on any new income. The concrete step now: front-load retirement accounts and reduce sequence of returns risk with some cash reserves. Ages 55 to 64. Now the richest 10% range between $3.5 million and $7 million. This is the payoff of decades of consistency. Their portfolio growth often exceeds their annual income. The mistake most people make here is shifting too safe too early. Maintaining some stock exposure helps fight inflation. Build a withdrawal plan, target around 3 to 4% annually. Create multiple income streams: dividends, rental income, part-time consulting. Protect capital, do not chase yield. At this level, wealth preservation equals wealth growth. Ages 65 and beyond. The richest 10% often hold $8 to $12 million or more. Withdrawals become the focus. The wealthiest retirees allocate assets to minimize taxes and maximize longevity. Action steps: delay Social Security if possible, optimize Medicare, and structure withdrawals from taxable accounts first. The wealthy also hold less emotional attachment to large homes. They downsize strategically. At this stage, staying wealthy is a plan, not an accident. The biggest threat is healthcare expenses, so plan with insurance and cash flow buffers. So how do you join the top 10%? First, prioritize savings rate over investment complexity. Second, automate everything. Third, increase income relentlessly. Skills, certifications, negotiation, or side businesses. Fourth, avoid lifestyle creep. Fifth, invest consistently in low-cost index funds. Sixth, avoid catastrophic mistakes, high-interest debt, oversized mortgages, and emotional market decisions. Wealth is not luck, it's behavior repeated for decades. The earlier you start, the easier it becomes. The later you start, the more aggressively you must act. The numbers look crazy, but every journey begins with habits, not millions.